foreign investment in Australia's real estate sector crashes. Let's have a look. Good evening, everyone. I'm Florian Heiser, and welcome to another episode of Heiser Says. I have my stein of coffee, and as I mentioned earlier today in a previous episode, I wanted to have a look at foreign investment in real estate. Now, a colleague, a viewer of the show, sent me this article, and I was reading through it, and I was shocked at what I discovered. Being an architect, I'm all familiar in years gone past where developers were completely dependent on foreign investment, where they'd be telling me, Florian, this job is going ahead just so long as we secure the Chinese buyers or the Chinese investors. So, I mean, in one regards, I've got no problem with people trying to get money away from evil communists, but have a look at what's actually been going on, because this is crazy. Let's have a read of this article. Foreign investors have abandoned the Australian real estate market en masse, new figures reveal, with economists now forecasting steeper house price falls and a Reserve Bank interest rate cut. Well, we saw that Reserve Bank cut this morning, didn't we? Well, a second one. A second one in as many months. And remember, guys, we're not technically in a recession yet. We're not technically in a recession. Just remember that. The value of approved purchases of Australian households by overseas investors has collapsed since the property price burst in 2017. New data from the Foreign Investment Review Board shows. So, foreign investment plunged by 58% year on year from $30 billion to $13 billion in the 2017-2018 fiscal year, the lowest level in nearly a decade, FIRB found. Now remember, let's just have a look at the scale of our export economy as a comparison. And what are we there? We're 243 billion in exports. So this foreign investment in our real estate is equal to more than 10% of that sector. It would be equivalent to, wait, we'll come back here. You know, let's have a look here. Iron ore is 48 billion. Coal is 47. Petroleum, so it's bigger than the petroleum, which is at $20 billion. Gold, it's probably about equal to our gold exports at 29 billion. So just put that in comparison. At the foreign investment in our housing sector was equal to all of the gold exported in the Australian economy. Might buy some gold mine shares. So, the data shows foreign investor enthusiasm for Australian homes continues to wane, flowing on from a 59% plunge in foreign investment in 2016-2017. And this is how investors fueled Australia's historic property boom. The figures show foreign investment in real estate returned to pre-property boom levels. Okay, they've gone back down. Foreign investment in Australian property experienced a super boom, rising 322% from 2012-2013 to a record 72 billion in 2015-2016. 72 billion. So that's more than double the gold exports from, I think that information I showed you was a couple of years old, but I mean, come on, guys, more than our iron ore, probably our gold combined. Well, no, our exports are what, 240 billion. So it's nearly a third, nearly equal to a third. Contributing to a dramatic rise in the cost of houses in Sydney and Melbourne that saw those markets peak in July and November 2017 respectively. So these huge house increases that we've had in Sydney and Melbourne, a lot of it has been driven by these foreign buyers. Now, I knew this was happening, but I didn't know how much until I saw this chart, and this chart shocked me. It shocked me. And let's just have a look at it a little bit, because I think it'll shock you too. Before I get into it, I need another sip of my coffee. So, figure 1. The FIRB approved investments in housing collapsed another 58% year on year. Okay, so let's have a look here. The red is FIRB approved investment in established housing. Okay, that's the red. You can see here. FIRB approved investment in new housing. That's the blue. And you've got FIRB approved investment in new housing as a share of ABS residential building approvals. Okay, now on this chart here, we've got the value in billions. So, you know, say in 1990, a bit under 20 billion. you know, hovering under there. And you can see most of it's new. There's a slither of existing established housing. And as a percentage of ABS, it was under 20. Sorry, under 20% over here. Sorry, the value of it is, I don't know, what would you say that is? 5%, maybe $2 or $3 billion. Okay, 99, and then we go, or you know, we just see it's tracking on there, but the percentage is 2020, then up to 40. We hit up to 40% of the residential approvals, and then it shot up. It shot up to here. What the? Okay, I'm doing it at a dodgy angle. Let's say 95%. No. Oh, sorry. Yeah, that'd be 95%. That's 90 in the middle. 95, 97% of ABS residential building approvals. Now, what are these building approvals? What are these building approvals? And I mentioned this now. This is building approvals to build new homes, new dwellings, residences. You know, and you've got total dwelling unit approved, and this was April this year, 14,000. Seasonally adjusted, you know, 14,000 here. You've got private sector homes, 8.5. Private sector dwellings excluding houses, 8.1. Apartments. Look at the difference. Now, if we go back here, think about it, in 2000, between 15 and 16, it got up to 97%. And let's look at the total number of dwellings back then, you know, well, right about here, boom. So say, this isn't scientific, 20,000. 90% of that is dependent on the foreign sector, foreign investment. Does that seem normal? Does that seem insanely high? But here is the real scary thing about all of this. Here's what is really scary for me. Now, this is an article written by Matt Berry from freelancer.com.au. The former CEO started it up. This is House of Cards. And I do want to go through it all. I'll put a link to it in the description, guys. It is like, I think, the world's longest LinkedIn article. It's fantastic. It's really good. Pretty much saying, you know, I recently watched the Federal Treasurer, Scott Morrison, so you can see it's a bit out of date, proudly proclaimed that Australia was in surprisingly good shape. Indeed, Australia has just snatched the world record from the Netherlands, achieving 104 quarters of growth without a recession, making this achievement the longest streak for any OECD country since 1970. So there you go. So this is a few years old, but it's, well, 2017. 2017. So just around this time here when it started to peter off. But there's one quote that he made that has stuck with me that I want to share with you. Okay, and I'll bring that in now, and we'll just read that. In 2016, 67% of Australia's GDP growth came from cities of Sydney and Melbourne, with both state and federal governments having done everything they can to fuel a runaway housing market. The small area from the city CBD to Macquarie Park is in the middle of an apartment building frenzy, alone contributing 24% of the country's entire GDP growth for 2016, according to SGS Economics and Planning. 24% of the growth for 2016 is located in a small area between the Sydney CBD and Macquarie Park, with these apartments that are going up. What's happening to these apartments? What am I talking about in other episodes? How much of this is foreign investment? How many of these developers are building here, selling to foreigners? How much of the money is getting siphoned overseas? I saw another article as well about ghost apartments in Sydney appearing. So, I mean, that is just insane. How the hell can we reach that levels? How can we do it? How can we do it? And what scares me is, you know, guys, you need to read that article if you haven't. I might do a a live stream, and we'll get a few beers and read through the whole thing together, but because it's a long one. But just think about that. Think about that. How much of GDP? What does that tell you about the rest of the country? So we'll get back to this article. The amount of foreign investor money pouring in sharply declined after 2015-2016, with the value of approved purchases collapsing by 83% in the following 2 years. 83%. Nationally, foreign investment in new housing dropped by 62% year on year to $10 billion in 2017-2018, with established housing down to $2 billion. So up from what? Over $72 billion, down to combined 12. Wow. New South Wales saw foreign real estate investment plunge by 33% year on year to $4 billion over the same period, while Victoria saw a fall of 53% to $5 billion. And here they're going to tell us 5 reasons why they believe for the plunge. But remember, one thing you have to think about, remember all of this, is that our states are have a conflict of interest in some ways, because they want to get as many people buying in here so they can get their stamp duty, they can get all their little money, the councils can get all their little money, and they can bugger it away on I don't know what they wasted on, probably special events at libraries in rural Victoria, things like that. So let's look at 5 reasons likely for the plunge. 5 key factors are likely behind the plunge in foreign investment. UBS economist George Tharineau said these include 1. An ongoing hike in government taxes on foreigners, including both upfront additional stamp duty and other material holding costs. So yes, we've seen that's happening. So the thing is, even if you're concerned about this change, if they all of a sudden start implementing these processes, they've already overheated the sector. They've already overheated the economy, so they're going to then cause a big problem in adjusting it. Oh boy. Far greater scrutiny of applicants, with residential investors now required to register on a residential land register, and the maximum share of dwellings in developments that could be sold to foreigners halving to 50%. Well, there you are. As I said, the projects I was talking to people who were putting teams together, saying, oh yeah, we just had to wait for all the Chinese investors. I've got friends who are trying to sell apartments that they bought a development in, and the guy keeps trying to bring in Chinese investors. I wonder if he realizes he can't sell more than 50%. So domestic lenders tighten for foreign buyers. Well, yeah, there's lending restrictions. And here we go, number 4. Tighter capital controls, especially in China, which accounts for 30% of all foreign investment in Australian real estate. 30%. 30%. So this figure here is approved investment in total real estate from China is still the largest share, but down 8% year on year. So the total growth, China, exempt other countries. So there you go. What do we have here? The value and the year on year percent changed. And a weaker outlook for house prices. These are the 5 reasons they're recommending. I wonder if the sovereign risk presented by Labor's policies may have made an impact. Perhaps not. I'm sure it did. So the fall in foreign investment is likely to see deepening house price declines and increase the likelihood of an RBA interest rate cut, which Mr. Thandon expects to see in November. Well, we've seen it and more. With an easing of policy towards foreigners not expected, the outlook for housing is still getting worse. We expect dwelling investment to fall sharply, with house prices to double the fall so far and drop a record 14% peak to trough. We will see a negative household wealth effect, causing consumption to moderate, GDP to ease below trend, and unemployment to tick up. So the problem is, if you still manage to keep your job, if there's a recession happening, times are getting tough, you're stuck in negative equity, how's that going to affect your purchasing decisions? I would say if you have a whole lot of people in negative equity, they are going to perhaps not be as inclined to make consumer purchases, or maybe tightening their belt, because you're essentially pushing a boulder up a hill constantly, again and again and again. So guys, a few surprising things here for me. I was shocked at how high this percentage is. I was really shocked. And I mean, this great quote here from Matt: 24% of the country's GDP growth for 2016 in just a quarter near Sydney. between the CBD and Macquarie Park. So think about that. If how much of that has come from foreign investment, where's the money going? Where's it staying? Who's keeping the profits? Other councils and governments that have been given the authority to, extract money from people, do they appreciate the responsibilities they have to the people they're taking that from, or are they pissing it away? I don't know, guys. Let me know what you think. This fall is insane. That is insane. This growth, this rapid growth, that's insane as well. That tells me you're overheating. That's what the RBA, the Reserve Bank, is what they'd hopefully try to do. The reason why they want to keep inflation at a particular level is they want to, get the economy growing steadily and consistently, just keeping it chugging along. You don't want an economy to overheat, because then you get these type of situations where it will crash right down real quick. You want it to be a much easier cycle of ups and downs, ups and downs. Look, see, this is much more natural. People can adjust and adapt, where boom, 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 boom. Yeah. No. That's something's going a bit crazy. Something's going a bit crazy, but bloody, that high, I'm still shocked. I'm still shocked. Anyway, guys, thank you for joining me for this episode of Heiser Says. Please like, share, and subscribe. Ding the bell to see my daily updates. And I'll see you all again tomorrow. Have a lovely day. Bye.